Let's face it, no one likes seeing stocks at their 52-week lows. It feels like you're standing at the edge of a cliff, right? Not to mention it makes every investor a little nervous. But here's the interesting part. Some of these stocks offer serious rewards in exchange for that risk, especially when it comes to dividend stocks that are handing out regular income even when their price has taken a hit. In today's video, I'm going to cover 5 dividend stocks that are sitting at their yearly lows. I'll show you and John exactly how much a $10,000 investment in each can make you. These stocks are ranked based on their potential to add value to your investment, starting from number 5, a solid addition to your portfolio, all the way to number 1, a must-have overlooked 52-week low stock. In the end, I'll show you a 52-week low stock that has the potential to turn $10,000 into a portfolio valued at over $4 million, paying over $25,000 in dividends every month. So let's get into our list of stocks. Number 5 on the list is Interparfums with the ticker IPAR, which is the owner of some of the famous brands like Jimmy Choo, Coach, and Mont Blanc, the heavy hitters in the world of luxury fragrances. But they've been hit low by the market as IPAR's stock has been chilling near its 52-week low. Now, at first, this might sound like a red flag, but judge just on one metric, because this could actually be an opportunity in disguise. Its price return is down 10.84% over the last year. Not ideal, right? But step back for a second and look at the bigger picture. Over the last decade, IPAR has posted a staggering 384.51% return. That's some serious long-term growth. It's the kind of performance that proves this company is built to handle the ups and downs. Perfect for investors who know that patience pays. Now, what makes IPAR really interesting is its dividend growth. They've got a forward dividend yield of 2.25% and a 5-year dividend growth rate of 23.17%. You're not just getting a nice little dividend now. Those payouts are growing year after year. So if you're in this for the long haul, you're basically setting yourself up for a steady stream of cash that just keeps getting bigger. Let's say John invests $10,000 into IPAR today. Using my stock valuation forecaster, after 1 year, he's looking at $11,730. Fast forward 10 years, and that $10,000 could be $47,693. And if he's playing the long game, 30 years down the road, that investment could balloon to $932,962 with an annual dividend payout of $5,027. That's $419 per month just from dividends. And the odds of missing out? Well, let's just say you'd have to try really hard not to benefit from this. With a beta of 0.79, it's actually less volatile than the market. You're not going to see those wild swings like you might with other stocks. And its price-to-earnings ratio of 23.76 is pretty reasonable for a company dealing in luxury goods. Profitability? They've got it. Gross profit margin sits at 55.83%, and they're converting that into serious cash with an EBIT margin of 17.53%. They're not just selling perfume. They're making money. Next up on the list is Steel Dynamics with the ticker STLD. Okay, so steel may not be as glamorous as luxury perfumes, but this stock has been quietly crushing it in the background. Despite some ups and downs, STLD is up 6.79% this year, and over the last 5 years, it's posted a massive 341.84% total return. Not bad for a company in the materials sector, right? Sure, the dividend yield is a modest 1.59%, but STLD's real appeal lies in its capital appreciation. Now here's where STLD shines, the dividend growth. They've grown their dividends at a solid 15.66% annually over the past 5 years. Their payout ratio is 14.19%, meaning they've got plenty of room to keep boosting those dividends as they rake in more earnings. And with an EBIT margin of 14.12% and a gross profit margin of 18.95%, they're not just surviving, they're thriving. This is a company that knows how to turn raw materials into profits. While the steel industry can be a bit volatile, Steel Dynamics has proven itself as a reliable performer. This stock does come with a bit more volatility. It's got a beta of 1.29, which means it swings a bit more than the overall market. But here's the thing. Those swings have worked in favor of investors over the long term. Just look at the numbers. Over the last decade, STLD has delivered a 472.11% return. So if John invests $10,000 in STLD today, his investment could grow to $11,828 after just 1 year. By the 10th year, his portfolio value is projected to reach $51,768, fueled in part by the company's average annual return of 16.69%. By the 20th year, John's investment could rise to $254,700. Fast forward to 30 years, and the value of the portfolio could skyrocket to $1,221,952, with dividends amounting to $2,143 per year. Still modest compared to the overall capital appreciation, but an important contributor to John's wealth. While the dividends are valuable, the real story in STLD is the extraordinary capital appreciation over time. So if you think $1 million is the peak for these bargain stocks, think again. In the end, I'll show you a 52-week low stock that has the potential to turn $10,000 into a portfolio valued at over $4 million and pays over $25,000 in dividends every month. Moving on to the third pick. Insperity, with the ticker symbol NSP, a stock that often flies under the radar, but it's a real player in the HR and business solutions space. Now, I know HR services might not sound like the most exciting sector, but hear me out. Insperity is a solid company that's been quietly stacking up gains, and it's sitting in a very interesting spot right now. Yeah, the stock is down 13.32% over the past year, which might make you second guess it at first, but if you zoom out, you'll see that Insperity has delivered a strong 663.35% return over the last decade. So while short-term performance has taken a hit, the long-term picture is still very attractive. It's a stock built for investors who play the long game and understand that patience pays off in spades. Now let's get into the dividend side of things. Insperity currently offers a forward dividend yield of 2.64%. That's pretty solid, but here's where it gets interesting. Their dividend growth rate over the last 10 years is 20.58%. So not only are you getting a decent yield, but those payouts are increasing at a healthy clip year after year. They've been raising dividends for 13 years straight, and with a payout ratio of just 43.26%, there's plenty of room for more growth. In terms of volatility, NSP is pretty steady. It's got a beta of 0.63, which is perfect for investors who want a reliable income stream without all the drama. So let's break it down for John. For NSP, John's initial $10,000 could grow to $12,193 by the end of the first year. By the 10th year, his investment could grow to $73,579, a reflection of the stock's average annual return of 19.29%. Fast forward to the 20th year, and John's portfolio could reach $558,592. Dividends at this stage would contribute $15,338 per year, or around $1,278 per month. By year 30, the investment could rise to $4,393,777, with yearly dividends hitting $136,631, or approximately $11,386 monthly. The second to last pick is Pool Corporation with the ticker POOL, dealing in pool supplies. You might be thinking, pool supplies? Really? But don't sleep on this one. Pool Corp has been riding the wave of outdoor living trends, and it's been raking in serious returns. The stock is down a bit, about 19.1% from its 52-week high, but that could be your chance to buy in. Over the past decade, Pool has delivered an incredible 591.11% return. This is a company that's been capitalizing on the rising demand for pool products, and they're not slowing down anytime soon. Now, the dividend yield is a modest 1.4%, but Pool has been increasing that payout for 13 consecutive years. The 10-year dividend growth rate is an impressive 22.98%, so while the yield isn't massive, it's growing, and growing fast. Pool has solid profitability too. Gross profit margin of 29.64%, return on equity of 31.96%, and its beta of 1.0 means it's basically moving in line with the market. Let's run the numbers. In Pool, John's $10,000 investment could grow to $12,136 after 1 year. By year 10, his portfolio might rise to $70,428. By the 20th year, John's portfolio could reach $517,867 with dividends providing $9,963 annually, or roughly $830 per month. By the 30th year, his portfolio could grow to $4,033,364, generating annual dividends of $103,306, which would equate to approximately $8,609 per month. Like NSP, Pool offers strong long-term capital appreciation, but it also becomes a significant source of dividend income after 20 years. Now for our last pick of the day, which will probably surprise you. The Winmark Corporation, with the ticker symbol WINA. This one's flying a bit under the radar, but it's a hidden gem in the resale retail game. You've probably seen their brands. Play It Again Sports, Once Upon a Child. They're not flashy, but they've built a solid business around secondhand goods, and their stock has been quietly delivering insane returns. Over the last 5 years, Winmark has posted a crazy 141.53% return, and over the last decade, the return has been 454.24%. But right now, the stock's trading about 21.64% below its 52-week high. So yeah, you could say it's on sale. About the dividends? Forward yield is sitting at 3.68%, but the real story is the 31% 10-year dividend growth rate. If we assume a conservative approach, let's say it keeps increasing its dividend by 20%. To top it off, it has a beta of 0.59, which means it's less volatile than the broader market. It's also incredibly profitable. A gross profit margin of 95.17% and an EBIT margin of 64.03% make this one of the most efficient companies in its space. And while the price-to-earnings ratio of 32.27 might seem high, it's backed by strong fundamentals. Bottom line, Winmark is for those investors who love the idea of growth with a steady hand. Now, before showing you how much John can earn from this 52-week low stock, let me show you where you can find all this data yourself. Moomoo, today's sponsor. Moomoo is an app that allows you to trade stocks, options, and ETFs from your laptop, iPad, or your phone, and they don't charge any commission fees unlike some other brokerages that do. It offers powerful free features like financial analysis, forecasting, and conditional orders, helping you spot bullish stocks and potential investment opportunities. New users can earn up to 8.1% APY on idle funds for 3 months and enjoy a generous welcome bonus including up to 15 free stocks and a 1.5% cash reward on initial transfers. Sign up using my link in the description, make a deposit, and take advantage of these amazing rewards. Don't miss out on this opportunity to enhance your trading experience with Moomoo. Now, back to the future projection of Winmark. John's $10,000 in Winmark could grow to $12,060 in the first year. By the 10th year, his portfolio could grow to $68,135, with dividend income still relatively small at $2,706 annually. But by the 20th year, Winmark's growth potential becomes evident as John's portfolio could reach $525,025, with dividends contributing $27,847 annually, or about $2,321 per month. By year 30, the portfolio could soar to $4,768,008, with annual dividends alone reaching $336,200, or a staggering $28,017 per month. Winmark stands out as the ultimate long-term growth and income play, as dividends become a big part of the overall returns after 20 years, adding a new level of financial independence for John.